All right. Thanks everybody for joining us at the July Sustainability Lab. We're going to be talking about the implications of climate change on insurance today. We have Dan Preby with us that I found him through the St. Louis Ac Office or Association of Actuaries. Is that,
It's the St. Louis Actuarial Club.
St. Louis Actuarial Club. I just did a random request to them to see if they had anybody that was interested in this topic, and they sent me Dan's info. So I'm happy that he he accepted. But we brought this topic up because I've been hearing about it in the news about how extreme weather events and the frequency and severity of them are causing issues with climate change, and it's been on our minds about it being a coastal issue. But then a couple of weeks ago, I read an article about there's towns in Iowa that have been dropped, and people can no longer get insurance there. So that hit a little bit closer to home. So I was interested in finding out more about this subject and seeing what we have to look forward to or plan for Missouri and Illinois. So I do think this is a topic that will be relevant for our climate action plan and our sustainability efforts. So I'm hoping to get more out of this than just an informational, just some information. I want to think about how we can incorporate this into our activities and think about what we need to keep in mind as we look to the future and plan for our communities. So hello, Kyle. So we will have the screen open. If we have any questions during the presentation, we will be open to answering questions. So if you're online, type it into the chat and I will bring it to the attention. And so without further ado, I will let Dan have the stage and give us his presentation.
All righty, thank you. And thank you all for having me. So as Aaron said, my name is Dan Preby, and I am an actuary that has about 35 years of business experience in insurance. I primarily work in healthcare, and currently the chief actuary for Lumeris here in town. We're a healthcare organization. We work a lot with providers and payers, trying to lead the way on value-based care. So I'm also a member of the board of directors for the Society of Actuaries, and a little bit about the Society of Actuaries. So we're the organization that educates actuaries and credentials actuaries. So that's one part of what we do. And a lot of it is also on research, and we'll get into talking a little bit about what we've done in researching climate change in particular. And I say as I near retirement, so I'm semi-retired at the moment, but as I near retirement, yeah.
Oh, I just heard this. Carol said hard to hear the speaker. So
okay.
The speaker is over here.
Over here. Okay,
yeah.
Sorry about that. So as I near retirement, I think that this is an area that I want to get more into, and I'll put it air quotes retirement, as I think that, as I think about it from an actuarial point of view, the financial risk of climate change are pretty significant in both midterm to long term. And I think it really is an area of focus that actuaries can really help with. What I'm presenting today is my own, so it's not anything with Lumeris and not anything with the Society of Actuaries. So I just wanted to have a little bit of a disclaimer that if there's any errors or anything like that, it's all on me, not on those guys. So with that, why don't we get into a couple of the things that I want to talk about. So we'll talk a little bit about key insurance aspects or concepts, and we'll talk about it at a real high level. And if we want to go deeper, just feel free to ask me questions, but we'll talk about the key concepts, and then we'll get into actual climate change and risk, and then how is it important to insurers, and then talk a little bit about mitigation. I have discussions and questions at the end, but feel free to chime in or jump in if you have any questions, and we'll just play that by ear then. So let's talk a little bit about the key insurance concepts. So the first thing is the types of insurance that are out there. So we have the property and casualty insurance. You'll hear us talk about P&C insurance, that type of thing. So that's like homeowners, auto insurance, workers' comp, crop insurance, all of those types of things. That's all on the PNC side. And then we have health insurance, and I'm sure you all know what that is, and same thing with life insurance. And then a catch-all that's everything else. So really, we're going to focus primarily on the first three, so PNC, health, and life. What's interesting about all of them is that there are two key concepts, and I'll throw in a bonus at the end there, but there's two key concepts that impact all of the insurance. So if you think about like what we call first principles, it's frequency and severity. So the frequency is how often does something happen? And the severity is if it does happen, how bad is it? So we tend to think of it in the terms of financial risks, but there's other risks as well, you know, when it blows down or things like that. So again, it's how often does it happen? And then if it does happen, how bad is it? And then the next thing, the bonus concept that's in there is the time horizon of what you're looking at. So with health insurance, the time horizon is typically like a 1-year term type of thing. And it's the same thing with property and casualty. Life insurance, it can be longer. And what's interesting about this is when like we think about this as consumers, we're thinking about buying the insurance. But when you're thinking about it from an insurance company's point of view, they're also thinking about their assets. So like what dollars do they have invested? And then how long do they need to keep those dollars invested? And so if you think of like a really catastrophic event, like a huge hurricane coming through, there's a good chance that 1 year's worth of premium may not cover all of that. So what they have to do is keep assets to be able to cover all of the potential liability or insurance risk that they have for whatever that event may have. So time horizon is really important as well. And that's more so on the property and casualty side than it is on the life and health side. So with that, why don't we actually just start talking about climate change? So I'm sure that you're all fairly familiar with a lot of what the extreme risks, extreme events that are out there. But according to the NOAA database, they have a huge list of what they consider extreme events or extreme climate events. And so you see them there. I've circled several that are really impact the Midwest here that may impact us. And there are more that I haven't, like funnel clouds at the bottom of the first column. I didn't, circle that. Yeah. There's some that they don't put in here, like a Derecho. That who would have known that term, a couple of years ago, except for what happened in Iowa. So these are the big things that happen. I would say in the Midwest. And when we think about these things, so these are things that just happened within the past couple of weeks. The one with the child on there is from today's headline. It was above the fold of today's St. Louis Post. It's talking about the heat that we're going to feel in the next couple of days. The other one is something that happened in Nashville a couple of weeks ago. So their dam burst because of excess rain, and they had to evacuate a ton of folks from Nashville because of this. And this is all just within the past couple of weeks. I was telling folks earlier that I have an actuarial colleague of mine who lives in Florida and was talking about his homeowner's insurance that is around $18,000 to $28,000 per year with the quotes that he was getting in Florida. So like multiples higher than what we actually have to pay here. And it was for a modest sized house. It wasn't for anything large.
Was that through the state system?
No, it was, I don't think it was. He didn't really specify, but I don't think it was. And then I have a brother-in-law who was in Houston when Beryl came through. And he didn't have water damage, but it was out, his electricity was out for 5 days. And then we got Beryl up here and there were flash floods. There's, I don't know if you know what's going on up in Canada. Have you heard of Jasper? 3 weeks ago. Okay. Yeah.
You
so,
can't see it.
Yeah. Yeah. So I have a sister-in-law who was planning a trip to go up to Jasper. And I've heard 50% of the town has burnt down. And so there's stories like this that you hear, and I think the prevalence of this type of thing is going to increase over time. And I'm sure that all of us have stories like that we can tell. So these were other things that I found, and there's just a plethora of stuff out there that you guys can find as well. But here were some things that I found that were specifically related either to the Midwest or Illinois. And so we have heat waves that the EPA is saying is going to increase over the course of the next several years. With the heat waves, let me back up a minute and actually go to what's at the bottom of the screen. So within Illinois, we're seeing an increase of temperatures of 1 to 2 degrees on average over the course of the past century or so, I think is what the article said, and 2 degrees at night. And what's important to call that out is that that's actually when things are supposed to kind of cool down, but we're seeing a greater increase at night than we're actually seeing during the day, at least according to this article. And then 40% of the number of days, or 40% increase in the number of days that have seen greater than 2 inches of rainfall in the last century. And then this 8 to 40 additional days with temperatures greater than 95 degrees. And the reason why this one is important is because from a clinician standpoint, so I'm not a clinician, this is just what I've read, is that at higher than 95 degrees, or let me say below 95 degrees, your body can naturally kind of cool itself down. But above 95 degrees, it becomes more difficult, or your body simply cannot cool itself down. So you need to do something else, go inside, cool down in some way. And so when we see the number of days of 95 degrees going up, that means that it could stress the healthcare system, because you're starting to see more of what's at the top of the screen, where you see these heat waves. And so you see these heat stress on people. Their air quality may be impacted, and I'll say the increase in exposure to diseases. This gets more into things about like standing water. And if we see more mosquitoes, bacteria, those types of things, that may be more prevalent in the hotter climates. We may see that more south, or rather moving up north. And so those types of things are going to impact the health of folks in, I would say, in the Midwest here. So any questions before I move on? All right, so let me get into a study that the Society of Actuaries did that is related to the nation as a whole, but you can see the impact of it in the bi-state region here. So this is the study that was put together to take a look at flooding in basically the US and what the impact is. Both from, like, again, a frequency standpoint, but also in total, what is the severity of the flooding that we'll actually see? And so a couple of the concepts that we'll talk about here is what the study calls on-plane flooding and off-plane flooding. So the on-plane flooding would be like down in the valley. If the Missouri River were to flood, then what would happen in the valley there? And that would be kind of on-plane flooding. The off-plane flooding is more of like urban flooding. So imagine like the rain that we got the other day, and flooding along maybe like 44 or Ladue or places like that. So it's really like I don't want to call it a flash flood, but it's those types of events that the off-plane flooding is referring to. Okay. So then this is a map of the United States. And the way to kind of read this, well, let me talk a little bit about some of the different acronyms that are on there. So one is the RP, which is its return period. And so what that means is how often would a storm or an event of a particular size, how long would it take from when it happened to return? So it says here 100-year return period is basically a 100-year event is kind of the way to read that. And so that's what the RP means. the GCM is, I have a note here, I'm forgetting offhand, but it's the model that's used to actually forecast what the may happen with flooding. And so it has 5 different scenarios that it's using, and what the study did was take an average of all 5 of them. And so the way to kind of read this is that on the left side of the screen, the one that's primarily green, what that's showing is what the flooding would look like on a 100-year event in 2020. So you can see through like the middle of the US, you can see where the Mississippi is. And then going on up here, you see where the Missouri River is. And so the flooding events for a 100-year event would be pretty high. Now, what the study did is saying, all right, if we move from 2020 to 2050, what's the change in those events? Okay, so what we're seeing inside this blue circle is that for the on-plane flooding, again, like again, down in the valley or things like that, we'll see an increase in that 100-year event of 50 millimeters. So think about like, I don't know, about call it maybe 2.5 inches of additional water that's coming in. Now that may not sound like a lot, but if you think about what may be flowing in from up north, that could actually be fairly large. You know, think of like some floods that have happened, you know, 1993 or whatever it was. So there's a high chance of a fairly large flood happening here. So that's what kind of how to interpret this this slide. So that was a lot. So let me stop here and see if anybody has any questions on this map here. So the takeaway is that the expectation is that a 100-year event would be more likely 30 years from now. One could extrapolate from that possibly that the chances of flood are going to increase as well.
Is I guess the SOA is Society of Actuaries?
Yes.
Is that who is your intended audience for that, the insurance industry, or?
It's for whoever is interested in it, actually. You'll see further on that it talks about expected losses. So the primary audience would be the insurance industry. You could actually find this report online though.
Mhm.
Yeah, so you could go through it yourself if you're interested.
Was there any, I don't think fact checking is the right word, but comparisons between like what the Corps of Engineers are predicting?
I'm not sure if there was. When I read through it, I don't recall seeing anything like that.
Okay.
So can I just clarify, you're saying that it seems likely that there's gonna be flooding potentially in this area both more frequently and that the events would be more
Intense, yeah, yeah. That's what one could infer from this type of graph. Now, the variability of that happening could be quite large, and we'll take a look at that in a minute here. A different type of event, but kind of get at what you're asking. So so that's the on-plane flooding. Now let's look at the off-plane flooding. And same idea. So the off-plane flooding on the left was through 2020, but then a 50 millimeter increase, about a 2.5 inch increase on the right side. You can see where the big green is kind of in the middle of that circle. That's our metro area. So then the authors of the study went on to say, all right, well, we know that that's the frequency side of it. We're expecting to have higher losses. All right, so what do the losses actually look like? And so the way to read this is that on the left side of the screen is the on-plane flooding losses. So again, these are what you see in the valley and I think Cairo, Illinois, didn't they have a flood a while back? That would be, I think, similar to this. I think it was more because of like the Ohio River and
They-
Mississippi River.
They blew up the levees across the river. So
Yeah,
it
yeah, okay,
Flooded the
okay.
farmland. And
Yeah,
City
yeah,
City.
so it's that type of thing. Now it's a little different because they blew it up, but I mean,
Right.
that's the plains that you're talking about.
Mhm. It just transferred the damage. I mean.
Yeah, yeah,
would've been a
exactly.
Town if they didn't do that.
And so what's really interesting is the one that's on the right. And that's the off-plain flooding. And so this would be like a flash flooding. And the increase in the potential losses that we're expecting from 2020 to 2050. The bright red is 100% increase over what we're actually seeing right now. Now, I don't have the dollar amounts, but it's basically saying that the potential losses because of the strength of the storms could be doubled in the next 30 years.
Just to see if I'm interpreting right, that third bullet where it says cross-reference with wildfire risk, all the red in the west is associated with wildfire risk.
So that's a good question. I think what they were doing was trying to cross-reference the losses as well.
Oh, I see.
Yeah.
So there's 100% chance that between flooding and fire,
Yeah.
the red is not where you want to be.
That's right. Yeah. Yeah.
That's just loss, no matter the, it's, right?
Um,
that what
Okay,
you're-
it's
Wildfire
not
feels like one of these things just kind of got thrown in there, but that's
Yeah.
a little bit of confusion.
Yeah, so let me double check on that, but I think the way that they did this. So here's what I think it is that the way that they did this was to use the losses on the wildfire to help like augment some of the data they had on the losses through the floods. And so X number of homes lost, here's the dollar amount that. I don't know that positively, so I'll double check.
But
that.
it makes sense. Loss is loss.
Right, right.
And all of those little like parcels would be counties. Is that-
That's correct. Yeah. And
For reservations, just to.
so this would be both your frequency and you have impacts of both your frequency and severity. So it's like how often does it happen and or what's the probability of it happening and then what's the loss if it does happen. So it's taking both into consideration. And that's what so the expected loss is basically doubled from 2020. So that's on the flood side. And so if we step back a minute and look at all of them, all of the potential events. And again, this data is from NOAA. And if we compare 2019 to 2023, we're seeing roughly about double the number of billion-dollar loss events. And the losses, the total amount of losses is also roughly doubled in the course of those 5 years. So that's kind of looking at everything. That's a national kind of event.
There was a question popped up about the maps is
Okay,
of
yeah,
why
yeah.
why they cut it off at 100% of change because there could be
that's a good
double
question.
losses.
Yeah, I don't know the answer to that.
All right, he'll get back to us on that question, Aaron.
Just making a note here. Okay. Yeah. All right, so we have the billion-dollar events. And now let's look at
Can I ask a question just on the left side?
Yeah.
That's actual spend, right? That's not projection.
That's correct. This is actual spend. And they actually have some information from 24 already, but it's not included. So, incredible. Yeah. Okay. So this is looking at tornadoes specifically in Missouri since 1950. So we're looking at what 70 plus years of data. And this information again is coming from NOAA. And there's a website that's listed, it's the newsleader.com website. And they do a nice job of actually summarizing that data, so you can go out and take a look at it and kind of play with it yourself. But what I did was I took that information and just graphed it to see what is the, with tornadoes, are we seeing an increase in tornadoes? And if so, like, what is that increase? And so if you look at from like 1950 on up through 2023, there's about a more than doubling of the number of tornadoes that have happened. And if you go from about 1990 to about 2023, it's about a 50% increase, going from, just kind of eyeballing it here, from about 35 per year on up to about 45 per year. I may have that off a little bit, but you get the idea, is that the expectation is that there's going to be more tornadoes. So a couple things to kind of point out from this, and from an insurance point of view, what kind of gives us a little bit of angst is that you see there's a lot of variability in the number of storms that there have been recorded. So we're seeing more and more storms, and but like the numbers are going really high and really down. So that type of variability is really risk from an insurance standpoint. And so the insurers will build in that type of risk into their premium rates, into their projections. Okay, so that's one thing to take away from it. The other thing is that in kind of playing around with the NOAA database, they also have different ways that these storms can be, like how they'll find out about the storm. So it may be by an individual, it may be by, you know, the weather centers throughout the state or the country, different ways that they can get it. So I was thinking, all right, well, is part of this difference due to the fact that they may have more ways to do it now than they did in 1950? And there may be some of that noise in there, but I was thinking, all right, if that's the case, then where the people are at is more likely where they're going to see more storms, right? So if we map all of the storms since 1950 of where they actually located by county, it's all over the map of Missouri. So it's not like it's located in just the urban areas. It's actually all over that they're seeing it, which kind of, not fully, but somewhat negated my concern that, you know, it's only, maybe it's because individuals are picking it up or things like that. So it's again, it's kind of, like I said, it's all over the state that we're seeing these storms. So I do think that, going back up a slide, that this is, I'll say in air quotes, truth, that it's not, you know, I'm sure there's some type of reporting bias, but probably not, doesn't explain all of that. So that said, what I did was that dotted blue line is basically like a trend line, if you will. And so we're seeing that increase, and the expectation is that we can see more and more of that. And I'm not a meteorologist, but my understanding is that as the temperature increases, there's more energy in the air, which is going to create more potential for storm or storm threats, and that's what's driving a lot of this. So that's again the frequency side of the equation for us. So now let's go into the dollar amounts. So this is from the same database. And I need to double check if they adjusted this for inflation and stuff. But either way, what we're seeing is an increase in the dollar amount of the damage done by the storm. And so you'll see again, as we get into about 2000 and later, that the variability of that is going to increase. And so again, from an insurance standpoint, that creates some angst, and they're going to build that variability or risk into whatever premium rates they put together. So if you kind of, look at this again, and if you're looking at 2011, which is where it really spikes, that's the Joplin tornado.
Mhm.
Okay.
And
So-
I guess having an extreme event like the Joplin tornado would change their estimates of how much they need to keep in reserve.
That's right. Yeah, yeah. So, and I don't know this because I don't work in that line of business, but what I suspect they're doing is they're not only looking at like in air quotes, a Missouri block of business, they're looking at their entire block of business or their entire book of business with the hopes that what's insured in Missouri, may be offset by less damage in, say, Kansas or something like that. So I don't think they look at it in isolation. However, the way that they set the rates would be more kind of, it is going to somewhat take this into consideration. Okay.
Is that peak above your graph?
Yeah.
Okay.
It was like $1 billion.
Yeah, it's like, exactly. This is like 300 million. It's like 4 times. I think it was like 1.1 or 1.2 million dollars was the loss. Billion dollars. Yes, thank you.
And can I ask, when you say loss, does that mean insurance payout?
Yes, yeah.
Okay, so it's the potential of non-insured loss or lost work time. All of these intangibles aren't a part of the cost. It's just how much was asked for recovery. That's what we call property damage.
That's what I think, but let me double check on the NOAA database on the definition of what that loss is.
I mean, I'm assuming it's
the insurance
yeah,
loss.
it's the
It could-
insurance receipts.
Yes, yeah,
That's
that's what
vague.
yeah.
Yeah, too bad about suffering. Yeah. Well, and it's reported.
Right,
So
that's what I mean.
who's capturing? Yeah. Oh,
What?
so Marty says that plus uninsured losses.
So it is, it
That's
does.
good to know.
Okay.
When we get into discussion, Marty is involved with the insurance industry in California.
Okay,
and
great,
Said she
great.
might have some
Yeah, thank you.
advice for us out here.
Yeah, that's very helpful.
All right, so this is the most like actuarial thing that I'll put on the thing here. I was curious to see if it grows exponentially, right? And then also the Joplin loss that we were talking about. What I did was just like a log transformation of the actual losses, just to see what it would look like. And what we're seeing is that it still is an increase over time. And so again, the expectation is that the severity of those losses is going to continue to increase. All right, so before I move on, any questions or anything? I see some comments coming in. I was just reading. Yeah, so there's good information out there that's beyond just what I was here. There's just a ton of information out there. So those are just some of the things that within the bi-state region that are impacting insurance. The database that has the tornadoes here, we could also look at floods. We could look at different things specifically for that, those types of events, that list of events that I had up on an earlier slide. So with that, let me get into the importance to insurers. So this is kind of kind of a mess of a chart, but basically the idea here is to say that climate change is becoming more and more of an issue within insurance. And there are different organizations that actually monitor insurance or that look at insurance that are starting to require more disclosure on what an insurer's risk may look like. And that's the point of this slide here. If we look at well, let me back up what I've put on the next couple of slides are particular issues in no particular order. So I just kind of like did a dump of some of the things that I've read, some of the things that I know, and just put them onto the slides here. So the first thing is there's going to be less predictability, as you saw from the previous slides. So there's as a result, there potential for greater increases in premium. Some of the examples of less predictability is, again, you got morbidity costs that may happen, size and strength of climate changes, and investments, which we'll get into in a little bit. And that's an aspect that a lot of folks don't think about when they think about insurance, but the investments are a big deal. And then some of the changes that insurers may make as a result of this type of risk is maybe shorter guarantees on the type of policy they have. They may exit the market or may selectively choose which markets they want to remain in. And then if they do remain, risk sharing with the insured. An extreme example of that would be like, let's say you have a value of a property and the insurer saying, I'm only going to insure 50% of the value of that. I don't know if that'll happen, but that's an example of a type of thing that will happen. I already mentioned price inflation. I've mentioned before that other types of organizations are interested in the climate risk that insurers face. So we have regulators. The ones that we deal with are the NAIC, which is the National Association of Insurance Commissioners. And they will require or may require disclosures on the type of insurance risk that you have or what type of insurance risk you have. Rating agencies of ones that give you an A, B, C, D rating, for instance, may also be interested in knowing what type of risk an insurance company is facing. And what's interesting here is that that's not only on insurance, but others, and what types of climate risk may other financial institutions or other, firms in other industries may have. And then there's the SEC. And so they all are ones that insurers are interested or have to work with. And again, they may have additional reporting requirements. The other thing that I threw on this slide was capital requirements. So there's enterprise risk management, and within the industry, we have something called RBC, or risk-based capital. And so as that variability increases, that means your risk is increasing, which potentially means the amount of capital that you have to hold increases as well. So it may be that insurers have to, again, hold more, so that might actually impact the premium rates. And then the last point on the bullet on the slide here is asset liability management. And so basically what that's saying is that you have long-term assets and short-term liabilities, and they don't match. So what they're trying to do is to say that you have liabilities out here or liabilities out here. Do your assets actually match? And with the variability that we were just pointing out, that makes it even riskier in some ways for an insurer to hold it. A good example of this would be like, let's say that an insurer has bought a bond, a long-term bond, and if they need to sell it early, they're not going to get the full interest rate on that bond. And if they have a real large event that happens, they could end up actually losing money because they invested in that bond and didn't realize the full interest rate. You guys followed? I mean, yeah.
So I heard in a different presentation somebody on the investments, I'd say that insurers or their reinsurance or whatever you want to call this, capital investments love to dabble up corporate green bonds.
Mhm.
And can you speak to that a little bit? Like, to me, I'm asking, like, is that because they think they're like, oh, well, it's solving the problem? It's like two things. It's like making the risk go down, hopefully with green bonds, their investments in renewables or whatever, transitioning, to like a more climate friendly economy. But then also insulating them from riskier bonds or different bonds. But I don't know. I'm just wondering about why he said that.
I don't know fully the answer to it. There's a lot of variabilities that would go into that, or variables that would go into that. So what does their overall investment portfolio look like? We'll actually get into this in a little bit, like what is their time frame they're looking at? And is it like the long term, like 30, 40, 50 years out, called 30 years out. It may be that they're trying to insulate their long-term returns from that. Hold the thought. There's another slide that's coming up that might be of interest to what you're talking about. So in any case, we got some capital issues. And your question actually hits on the asset risk. And then of course you have your operational risks. And I put in here compounding risks. So things like this would be let's say that there's a breakdown in the energy infrastructure or the electricity infrastructure, and that impacts the healthcare infrastructure. And say it's an event that happens for a week or 2 weeks. Is that going to, or how is that going to impact health? And you can imagine it on like a hospital, but they probably have their own generators. So it's going to be mitigated in that way, but maybe not for an individual. So think of somebody who may have be on some type of medication that needs to be refrigerated. And so if there's a long-term, I'll say long-term, say a week-long or 2-week-long event that happens that takes down the electricity grid, is that going to put that individual in danger? And the answer is most likely yes. So go back to my brother-in-law down in Texas, in his example. It was only out for a couple of days, but it kind of hits the point of what we're talking about here. And this last point I put down here, it's probably an extreme. It probably wouldn't happen because of other ways to get food, but could, like a really bad crop issue, come up where we have then some type of food shortage. But you get the idea that a lot of this stuff is actually interrelated. And so something that happens over here that you're thinking about may just be like a PNC risk, could actually impact other areas as well. Okay.
That's a question about that. That's not new.
No, it's not.
So is it just that it's becoming more extreme that it's getting attention in the actuarial space?
It's already kind of built in. So the idea isn't so much here to talk about, how do I say this? It's already kind of built in. So if we think about like health insurance as an example. So typically what a health insurer would do is to say, I have my experience from last year or the last 2 years, and I'm going to take that experience and I'm going to trend that forward to this year or the following year in order to set my new rates or in order to do whatever I need to do. Okay, so when we set the assumption for the trend rate, some of that stuff will already be in there. So it's already kind of embedded in some of the shorter term kind of things. If you're thinking about it from like say a hospital system's point of view, it's not necessarily new. However, if they're thinking about it from a strategic point of view, as opposed to a business kind of, I'll say short-term business point of view, from a strategic point of view, should they be making investments into, I mentioned generators or other ways to help the community out if the event that I was talking about may happen. Or like, you know, lower income communities that may be at higher risk, or there are ways that they can reach out to that. So it's kind of planning for not just the immediate, you know, say the next, through the end of this decade, but thinking out maybe, you know, 2-3 decades out. Okay, that's helpful. All right. Keep wanting to say, there is a future slide that's coming up on that, that'll hit that topic as well.
We'll stop asking
No,
questions.
that's all right, that's all right. There's a lot of words on here, but this is something that's going to affect all insurers, and so there's not going to be an insurer that's not affected. So it's an industry-wide kind of systemic, it's really a society-wide systemic issues. As we mentioned before, we have many risks simultaneously. And I think that you know, we've already mentioned like the lower socioeconomic risks, or I mentioned that just now. I think that still needs to be on the radar. And then a lot of what we're talking about in order to kind of mitigate a lot of this risk is there needs to be some type of public-private discussion, you know, public and I don't want to say public-private discussion, but really public and private industry discussion. Let me skip this slide for right now. This is the investment slide, so I'll give you a minute to kind of read through this.
I might need more than a minute.
All right. And Krista, this will get at what you were asking about earlier. Let me know when you're wanting to start talking again. So what this is, what it is for one, this is verbatim from an email that I personally received from a broker, from an investment advisor, talking about climate risk and saying, here's what, you know, if you have a portfolio, here's what to consider. And so the first thing was diversify geographically. And so they were advising that you go with at least 10 different areas. Okay. And then the next thing was favoring higher rated insurers or issuers. And this, I think, is key in a way, because if it really does get into the risk that different municipalities may have or different regions may have, and depending on their risk, they may or may not be able to get investments into whatever bonds they may actually issue. And then that gets into the last one of talking about shorter term bonds and, you know, whether or not they should invest in them. And this last point mentions out migration. And I think when we think about, like, again, the slide you'll see is actually short term. So it says short term being by the end of this decade. And then the long term being from 2030 to 2050. Okay, and so how do you think about that? And so this is kind of getting at that as well. And so if you think about like the asset side of an insurer, what are they going to invest in? And so it may be that they don't want to invest in communities that have high risk, not only from the event point of view, but are they going to see out migration so they don't actually have the tax base to be able to fund the bonds? And so it's an interesting kind of thought on this. And this next slide, we can send out the slides here, but the point is the example here is this last one. And they're talking about Miami-Dade County Airport versus someplace like Denver or O'Hare. So would an investor be willing to invest their money for a 30-year bond in Miami-Dade where there's all kinds of risk, or go up to, you know, if a bond were issued by O'Hare or in Chicago or Illinois, would they invest there? And so the intent of showing this is that there's risk not only from the insurance, you know, what you think of as insurance side, but I think there's risk to the community in what may or may not be invested in that community. So this gets to the policy and the policy making of the communities and what they are doing long term, because they have to get their own investments. If you follow what I mean. So that's the idea of that tangent.
Can I ask a quick question on that?
Yeah.
Is that also a reflection of the cultural normalization that this is a real and imperative reality versus I sure hope if I don't talk about it, it's not real?
Yeah.
Kind of like the flood risk.
Yeah.
You know, I'm still going to build my house in the floodplain because that's cheap land.
Yeah. It's still,
But I'm not going to get into the reality that I shouldn't be able to even get insurance for that house.
That's right.
Because of the associated potential payout risk.
Yeah. So if I think about it from an insurance point of view or a company point of view, then in my mind, for my book of business, that is a real risk. And I am going to not lose money on that risk. I'm a business person, right? So I should be able to make money on my business. And so if somebody were to build in a place where there's a floodplain, I'm going to charge for it or I'm not going to insure that risk, right? And so you'll see that, and regardless of what the individual consumer may be thinking, what policymakers may be thinking, it's a reality in what's happening to the business of insurance. And so they're going to make the appropriate business decisions regardless of it.
So there's the potential that the culture shift, and I mean that by mentality, could be sourced from the insurance and reinsurance industry pushing, hey, we got to pay attention to this, versus policymakers saying my success is measured in growth and I need those houses to be built on this floodplain.
Yeah.
You know, realities be damned.
Yeah. So I'm of the opinion that the insurers will make the appropriate business decision that's good for them. And I hate to do this for members of the audience, but I'm going to call out Marty on this. And Marty, I'm curious to hear your thoughts from your experience in California.
I'm sorry, just help me with thoughts on exactly what again?
So that's your question.
Sure. So Marty, what I was just inquiring about is how a lot of what we just read in the tangent for investments is an interrelationship between our, I'm going to call it a cultural pushback against these shifting realities and the just reality.
Yeah.
So what I was inquiring about is the potential of insurance and reinsurance, knowing that you can't really put out a policy unless you're going to get paid back on it. So that I'm sure you're going to speak to the relationship between reinsurers and So
yeah, in fact, I think it's
so I was just inquiring about the role of insurance to push this mentality shift. But I'm also concerned that I'm bringing up a topic that belongs in discussion and probably shouldn't have been brought up in the first place.
Well, it's definitely the reinsurers who have pushed the crisis in insurance in California because they just made it impossible for the insurance companies to keep up their business under that business model that's regulated in California. But the biggest difference in California too is that in order to sort of manage premium costs for homeowners here, the insurance regulator for a very long time has not allowed the insurance companies to use catastrophe modeling in setting premium costs. And so that's the big change that's being proposed now to try to get the insurance companies back in the market. And it will allow them to make some pretty significant increasing adjustments to the premium costs and allow the market to regularize, I think is maybe the term to think about, but it's going to result in significantly increased premiums across the board for people in California. And that's in addition to huge premium and costs that have already been implemented to reflect the replacement cost and increase in cost for construction.
And then Florida, I think, is similarly situated.
Yeah,
Okay.
I'd agree with that.
Well, hopefully that answers the question for now.
Yeah, for sure. Okay. I mean, there's no.
All right. And I won't belabor this. This is really just talking about, so the Geneva Association has talked about different ways to take a look at risk, and they presented or come up with a format to talk about risk. And they've broken it down into two different risk types, if you will. One is the physical risk, and the other one is what we'll call transitional risk. So the physical risks are arising from the actual event itself, whereas the transition risk is moving from the current situation that we're in into a low carbon economy. And the way they've done this is by a couple of questions that have come up earlier is they look at it by timeframes. And so that's what the rows are. So you'll see that the short-term business goes from basically to the end of this decade. And then the long-term strategic planning is going from 2030 to about 2050. And then the columns are different types of risks. So within the physical risk, you have the chronic risk, and those would be ongoing things that you'll constantly see. And then the acute risk would be like a hurricane coming through. It's very, again, acute. And then the transitional risks are things that like your policy risk, litigation risk, market or technological risks. Are the policymakers going to do things that may help mitigate whatever overall risks are? Same thing with the litigation, marketing, technology.
What was the name of that report?
It's called the Climate Change Risk Assessment for the Insurance Industry.
And is Geneva Association reinsurer? I mean, I kind of put Geneva and reinsurers together, but that just might be me.
No, I don't think it's specifically for reinsurance, but it is a global view of things.
Okay. So that is the Geneva Association of Business, or is that a whatever you call it, a collection of trade association.
I think it's more of an association. That's something as well. Okay.
Sure. Yeah. Sorry.
So I just wanted to put this out there as kind of a framework of what they're suggesting of how to look at this. And there are examples that they give in the report that I have mentioned there. And it's broken down by like insurance type. So like PNC versus life. And then it also talks about which side of the balance sheet. So are you talking about the liabilities or the assets that it actually has? So with that, why don't we start talking a little bit about mitigation? So generally, and then we'll talk more about a framework that I put together. So generally, what we're interested in is anything that's going to reduce the frequency or severity that's going to mitigate the risk from the insurance company's point of view, and really from anybody's point of view. We've mentioned before, what are the different possible actions that they can take that also can mitigate the risk? They could withdraw from regions, they could change the policies, they could increase the premium. And then there are things that still need to be considered as well, away from just insurance, are the downstream impacts of whatever is decided, not only by insurance companies for others, but from an insurance company point of view, can the consumers afford it? And if they can't, then the risk is going to flow to the lenders. And then that could create some type of systemic issue to the financial industry just in general. And an extreme example of that, not necessarily related to climate change, but call it mortgages, is what happened in 2008 and 2009, where it was just a systemic risk that was pushed back to the lenders because so many folks couldn't afford the mortgage. I mean, there are other reasons that caused it, but that's an example that one could look at.
Is the industry, I mean, answer as general as you can, is the industry embracing this, reducing frequency and severity? I mean, because that's climate action.
Yeah.
I mean, is that fringe thinking or?
No, it's like, again, it's like those two items are foundational principles for the insurance industry. So they're always looking at frequency and severity. And specifically regarding climate change, I saw a comment in that report that was talking about the short term. That middle row, they actually said in the short term, there's not much change that can actually happen. And what will happen, in other words, that there's like not much mitigation that they're expecting from policy changes or things like that. Because it's kind of already within the climate.
Mhm.
And so there's not a large expectation of it. And I'm paraphrasing, but that's one thing that was mentioned in the report. And so in my example of the health insurance and what you're doing is taking previous experience, trending it forward and putting it in here, it's going to be built in to what we're putting together. The same thing with a P&C company. They're going to take prior experience, build in what their expectations are, and that's going to be the future. There, according to the comment that was made in that report, it sounded like there's not like an actual, I think there's going to be good mitigation, so I'm going to decrease my premium by 10%. I don't think that anybody's doing that. You follow what I mean?
Well, I'm looking, I'm always, since I have to write a climate action plan, I'm looking for,
Yeah.
Allies. And
Yeah.
If I could go to the people, if I could bring someone like an insurance industry rep to, naysayers to help support, say you need to work on this.
Yeah.
Just
I think it goes, like, if it's okay for me to interject, like, I think that nexus is exactly what I was talking about, right? So if the insurance company is looking to like have solid assets to be able to pay for these expenses that are for sure coming, right? And only increasing in severity. And if they charge too much, then nobody's gonna pay and the whole thing collapses, right?
Right.
And so what I heard from, like, this was from BlackRock, they said that the insurance companies in particular are buying up green corporate bonds. So like North Face, that company, BF, they've issued $1 billion in green bonds for their transition so they can do it quick and spread out the cost long term, because companies can't pay $1 billion. Like, they can't just say, investors, sorry, hold on, we'll pay later. So they're lowering their cost of capital, like borrowing to finance the transition so they can afford to pay now. That them doing like the right thing, like transitioning now, helps decrease the long-term risks for the insurers. And it also, when you look at municipalities, I see it as like basically, so there's a paradox, right? When you're looking at muni bonds, like the cities most at risk, like St. Louis, there's a lot of flooding risk and other types of heat risk, whatever. like that's gonna be less attractive to investors, but they need to have more money to run their city because they have to invest in mitigation. And so that's where I think your insurer can be an ally, where you can say, we want to keep paying you insurance, but we need this bond money to help us afford it. We need to pay now, so we'll cost you less later, like being able to make that case about the short-term, long-term connections financially.
Yeah.
Keeps everybody in business, everybody,
Mhm.
the insurance, the bankers, the investors, everybody's happy if you can pay less right now, spread it out long-term. But you can, build the flood walls higher, whatever you need.
Yeah, so that was much more eloquently stated
That's
than I would
okay.
have put together.
I've been thinking about it for a long time. You probably
Okay.
haven't had as much movement time. I have to go get a green bond, I think, so go sell one.
So but what you're saying actually hits at one of the things that I wanted to get at is that it's all interrelated. And so whatever happens, with the tug and a pull is going to impact the reaction and actions of everybody that's within this ecosystem. And so I think that that's really important to kind of call out. So thank you for saying that. And that was actually kind of the point of this slide, but is just to say exactly that.
Dan, we have 5 minutes
5
left.
minutes, okay.
Yeah.
So we'll get to the policymakers regulations that may help with say installing solar panels. So there was an article maybe a week or two ago about Germany actually changing some of their policies. And now apartment residents and like condos, those people can put in their own solar panels, just like one panel. They can hang it on their balcony, and it's enough energy to run like what they said in the article was a refrigerator. I would assume like a small AC unit, which could actually go a long way to helping folks that may not have, in a power outage, may not have access to that.
They have much more efficient refrigerators in Europe than
Okay.
we do here.
So in any case, that's just an example in talking about construction. So are there things that they could do to make it better in the construction? Maybe tax breaks for friendly solutions, those types of things. We've all heard of green spaces downtown. Regulators, we've talked a lot about data and what they could do as far as transparency and helping that out. And then let's see, the industries, of course, reduce their climate footprint. Getting back to data, data is really important for people with what I do. And then community outreach, again, and trying to help out with lower income folks as well. And then individuals, just the normal stuff. I was walking around South Bend. I had some nieces who graduate in May, so I was walking around. And there were so many yards that were just not mowed. And I asked my brother-in-law, and he said, well, it's because it was no mow May. So they just weren't for May, just not mowing. So, it's just things like that.
It used to be no mow May here, but then our biodiversity folks said those pollinators are coming out in April. So it's no
All
mow
right,
April
all
here
right,
now.
all right. Okay, well, that's interesting. So, and then I was talking with another actuary, and these were some ideas that he gave me as well as far as some of the mitigation. And I like some of the things that he was talking about. You had mentioned not building in flooding zones. So that's one thing. And then in construction, the fire and wind materials, those types of things. So just some food for thought on some mitigation. And with that, I think that's it. So
Great. We still have a couple minutes before
Okay.
5. And any questions in the room or online? What's that?
How about how local is this conversation?
oh, this is huge. Yeah, this is big. I would say just anecdotally, based off of some of the literature that I've read and where it's coming from, it's a bigger deal outside of the United States.
That
than it
was,
is.
yeah, what I was figuring.
Right now.
Yeah.
I think it'll
Yeah, yeah.
change pretty
Well,
soon.
and so one of the things I love about this insurance topic is it's going to be the introduction to real impact versus conceptual polar bear stuff. So I feel like it will be a standard bearer for we need to respond in whatever manner we can. So frankly, I'm kind of excited to know more about this, just to facilitate you do know this is happening right now conversation.
Yeah.
Instead of it's for somebody else by somebody else.
And we may not feel it exactly here in the Midwest, but they're certainly feeling it in Florida, California, most likely Texas and other places. So, and based off of some of the graphs we've just looked at, I expect it's coming through for us as well.
Yeah, we're feeling it, just not to the extent. I mean, everybody I talk to, their home insurance skyrocketed over the last year.
Yeah.
Mine doubled.
My worry is people don't know why.
Yeah.
They just think it's greedy insurance companies.
Mhm.
You know, it's the man
Yeah.
instead of the people. You know, it's
My insurance agent blamed it on at the time there had just been a hailstorm in St. Charles, and so he was blaming it on hailstorms. Yeah.
I have a question about workers' comp insurance. Like, what did in your preparation, did you see anything about heat stress related impacts to or forecasts in workers' comp?
So nothing formal. It's just more of what I saw was in articles and anecdotally. And you know, there's comments about Florida, what they've done down there but that it is increasing. And like most of what I've read was stories about people who may have actually been hurt and the prevalence of it increasing. I'm sure that there are statistics out there that show what the increase may actually be. As a matter of fact, I think I did see something that they may have something. I'll have to look and see if I can find something.
I'd love to know. Like, the things that I'm most desperate about are just like, I'm trying to predict costs forward. So if I'm a business analyst, you know, and I'm trying to anticipate how our insurance rates are going to change in the near and long term. The big question, like in terms of business insurance, and especially if I'm diversifying across all the states.
Yeah.
That's
Yeah.
workers' comp, property.
So Aaron Michaels had a question online about the mitigation part in the insurance industry. I think that the answer was they're investing in mitigation right now. We didn't talk about lobbying, but that's the part that I think we can try to draw out a little bit more during our climate action plan is what of this information do we need to bring to our decision makers and policymakers? And that's
what I was just thinking about. And, you know, that St. Louis County is currently undergoing the plan, you know, long-term plan process, you know, where they're primarily driven by land use, but they're looking at other things. And, you know, how is that interrelated with bonds, you know, with insurance, with, you know, policy that would drive people not to build on floodplains, you know, because if you put in, and I don't have the answer to that, but it seems like that's well connected, this conversation to that process. And any other planning process, really, any other regional planning process that's happening, cities.
Well, and it's almost invisible.
Right, it
And-
feels that way,
yeah.
doesn't it? Yeah.
And yet it's right in front of us.
Yeah. The investing was, she mentioned that companies are buying green bonds and
No, like companies issue bonds.
companies issue.
Yeah,
Okay.
just like a city, like if a company needs to raise capital, they can issue corporate bonds. And you can get those bonds rated green, you know, or just not green, just regular, you know, and then investors buy, you know, those are corporate bonds. And so that it is a way for companies to raise money for building, or, you know, whatever, just like anybody else can.
Like the school district would. do
Yeah,
the same.
totally.
Yeah.
To make a new building, hospital. And so, yeah, like my mom just bought a big one for children's hospital the other day, you know, and so, yeah, so it's corporates do the same thing, just corporate equity investments. And so it's a way for, like, if a company goes to a bank and borrows money from a bank, they might get like 12% interest, or if they're a newer company, they're gonna get like 20% interest, but if they go get a bond, they might get more like 5% interest, you know, and they might be able to spread out the terms over 20 years, you know what I mean? So it really changes the dynamic of the payback period or the rate of return, you know, like you can really lower the hurdle to getting it to make sense, short and long term, you know, make the investors happy to get them consent. To me, it
Great.
makes the most sense for solving these problems for companies, you know.
Yeah.
to make it- So, and do it fast, you know, like spend it now, pay for it.
Okay. Well, thanks, everybody, and thanks, Dan, for
Oh, my
coming and
pleasure.
presenting.
Yeah.
Like we just scratched the surface and there's still a lot of questions. So Dan said he is interested in keeping in touch with us.
Yeah.
And I am fascinated and got to figure out how to get this worked into our climate vulnerability assessment and our climate action plan. So this is just the first conversation on it that we'll be having. We'll be stay tuned for future conversations.
Thanks.
Thanks, everybody.
so much. Yeah, thank all of you. Thanks for your time. So. appreciate it.